welcome to Your Hometown Solutions. I'm Jean Newell, your host from Waterview Realty. And in the studios with me today is one of my favorite co-hosts, Carolyn Wolf with Certified Mortgage Planners. Hello, Carolyn.
Hi, Jean.
So happy that you're here today because we're going to kind of pick up on some of the things that we discussed several weeks ago on mortgages and qualifying and various things. And we're going to kind of go through some of the things that people might not be aware of and review what we already discussed. But also in the studios, we have one of our esteemed guests who's been on before, and that's Eric Morgan, who is a attorney here in the Melbourne area. And Eric, he specializes in bankruptcy, criminal law. Hello, Eric. Why don't you just tell us some of the things that you specialize in?
Thank you. Yeah, I do handle a lot of bankruptcy. I have a website, spacecoastbankruptcy.com, also criminal defense and traffic through spacecoastdefense.com. And then I also do a little bit of injury law, spacecoastinjury.com.
Oh, great. Oh, we'll be repeating that if you missed it. So you're probably wondering, how is a mortgage broker and an attorney, how are we going to blend these two shows together? Well, believe it or not, we have a lot of ties with getting a new financing or going out and getting a new loan and all the things that happens when you start pulling your credit cards and credit reports. So, Eric, just give us a minute or two. Let's talk to Carolyn about the first step when before we're even looking at homes. We want to pull their credit report. We want to get not approval, it's the pre-author. Gosh, I can't even think what it's called now.
The pre-qualification?
Qualifications. I'm getting tongue-tied. So let's start there because that's going to open up a whole new series of topics when it comes to maybe their credit and what they need to do or what they don't need to do to improve their credit. So we discussed in earlier shows the difference between a broker and a banker and so forth. But let's do that again kind of quickly. Let's talk about the difference between a broker and a banker because and what you do as a service that's so important.
Okay, great. First, I do want to also mention that I am. My name is Carolyn Wolf, and I'm with Certified Mortgage Planners.
And you need a big number.
Yes, my NMLS registration number is 268538.
I wonder why licensed real estate agents don't have to give out our license number.
I don't know. We're
federally
regulated.
Do you have to do anything, Eric, with law? Do you have any kind of a license number you have to share? No.
Sure. Any motion that I file with the court, any notice of hearing, anything on paper that I sign and file has to have my
But you don't have to say it on air. See, Carolyn has to.
I'm happy to say it.
Yes, we are required.
They're required to say it.
Yes.
It's amazing. Well, let's talk about the broker-banker, what the difference is, and what's involved with before people start looking for a house, why they would want to call you ahead of time. And possibly even 3 or 6 months out.
There are a couple of big differences between going straight to a bank and or working with a broker. The biggest difference is as a mortgage broker, we are not only are we registered with the NMLS as far as our number, but we are also tested and licensed with the state that we do business in, whereas a banker just has to be registered. The other really big one for consumers is with a bank, you have just them to work with. It's just their specific guidelines, and we all have standard guidelines that we have to adhere to, but each individual lender or bank can add to those specific guidelines. So sometimes you might go into your actual bank and get denied for one reason or another. So you're thinking that nobody would help you when it's not the case 90% of the time. And with the broker, we are signed up with numerous lenders. So we have all different types of options and avenues to work with for certain people. Because sometimes people have a little bit of a niche where we need to put them, and one lender will do it and one won't.
This might not seem to be the appropriate part of the interview to talk about this, but since we have Eric right here, a lot of people might think, gosh, I had a bankruptcy a few years ago. I probably will never qualify for a mortgage again. First of all, Eric, what's the time frame that they have to wait to where their credit is pretty well cleared up?
Well, it can vary, but I have met quite a few people who've bought new homes at approximately 3 years after having filed their first bankruptcy. but it does depend on what type of loan they're getting, whether it's a FHA or some other type of loan. And every bank has their own policy on when they're going to loan after a bankruptcy,
Right.
if they're going to loan. And the other thing I'd just point out is,
I meant kind of in general, wasn't it 9 years you have to wait before your credit kind of turns around? Or
No.
They
No.
come off of credit after 10 years.
10 years, okay.
A bankruptcy. That's just where it's being reported, but it
Okay.
doesn't necessarily keep you from getting any financing.
Okay, that's good. So you can probably answer that question now, Carolyn, a little bit more as far as you have, sometimes they get foreclosed on different avenues, but they're not out of the picture.
No, not at all.
You can still get financing. It might not be at the lowest interest rate, but
well,
there's
just like
still
Eric
some
was
things.
saying, there's a general rule that most of us have to go by, but nowadays too, there's a couple of different private lenders that'll come into the picture where you could actually do it a day out of bankruptcy. It just really does depend. It depends on the bankruptcy and the circumstance.
Well, while we're talking about that, because credit reports are so important, whether you're financing a house or getting a car, it doesn't matter what it is, you want to get your credit scores as high as possible. If you've just come out of a bankruptcy, let's say Eric Morgan with Morgan Law, what would they need to do that you could maybe share with them, or maybe Carolyn, you could comment on what they need to do to start establishing credit again so their credit line starts growing, or their credit scores?
Yeah, just to pick up a thread from before that we didn't quite capture. I mean, buying a house, there's so many variables. It's not just about when they filed their last
Right.
bankruptcy. It's also how much of a down payment do they have?
Exactly.
What is their income? What house, is it that they're buying? What type of collateral will the bank have? What are the bank's interests in terms of having loans in certain areas or neighborhoods or regions? So there's a lot of different factors. It's not just about when they filed their bankruptcy
Okay.
as to whether they're going to
Good
get
points.
the loan. But as far as coming out of a bankruptcy, some people are going to be reaffirming their debt maybe on a car or on a home, and so their on-time payments going forward are going to help them rebuild faster than a person who maybe did not reaffirm their debt on a home or a car payment that they had at the time of filing. But even if people did not reaffirm, then they're going to want to obviously have some income and then be incurring some debt and paying it back on time. And there's a lot of those tips out there of like, if you've had if you have a balance, you don't want to max out that balance. If you're
On a credit card,
if your creditor's willing to give you a greater available possible amount of possible lending, you want to accept that, because the ratio between how much you've borrowed versus how much you can borrow, that affects your credit. It's very nuanced. And a lot of people, especially after a bankruptcy, they don't want to ever have credit, or they only want to have the tiniest little amount of available credit, and that does hold them back. More so than just the fact that they filed bankruptcy, that they're not playing the game of rebuilding credit.
Exactly. Now, I just wanted to check with you too, Eric. Can you explain again what reaffirm means?
Right. So when a bank makes a loan on collateral, that obviously if it's not paid, they can take the collateral back, and they can also go after the original borrower if they sell that collateral for less than what was borrowed to buy it. So if the house was bought for $150 and it's sold in a foreclosure sale for $100, that leaves $50,000 that's a deficiency, and they if a person's not filed a bankruptcy, the bank could then go after that person for the unpaid $50,000.
Okay.
Now, when a person files a bankruptcy, they can choose to not reaffirm their debt, but maybe keep paying on that house. But they don't personally owe on that loan anymore. But the bank still has its interest in the home. So if 3 years after a bankruptcy, the person did not reaffirm, they lose their job and they can't pay, the bank could foreclose on that home, but they would not be able to come after that person for any deficiency. But if the person had reaffirmed, however, and they lose their job 3 years later, then the bank could. So it's re-promising to pay on a loan that would otherwise have been discharged in the bankruptcy.
Right. Okay, so it's like keeping that house or keeping that car
and keeping
and then letting
loan.
everything else go in the bankruptcy. And you continue to make the payments
right.
on those.
You can only reaffirm on collateral. So you can't reaffirm just on a regular credit card or some loan from a family member. You can only reaffirm on collateral, such as a boat, car, house, something like that.
Okay.
What exactly would be the pros and cons about reaffirming? When do you not want to reaffirm?
So you don't want to reaffirm if your income and job are unstable. You don't want to reaffirm if you owe way more on something than it's worth. You don't want to reaffirm if the deal you got was terrible. The interest rate is way too high, or the car doesn't work, or the house has repairs that you're not going to be able to manage. I remember, a few years back, I had a teacher, and that her house had some horrible roof problems. She had enough money to pay the mortgage every month, but she had no money to maintain that home, and so she ended up not doing the reaffirmation because, while it was going to be good for the next few years, eventually it was going to be unlivable, and she just didn't have the money to maintain it.
Right.
If you don't reaffirm, does that give the mortgage company an opportunity to say, well, you really don't have any, anything into this anymore? We can maybe take back your mortgage or do something that's not within the guidelines that you originally signed with?
I've never seen that happen. It just means that on-time payments you don't get credit for that. So that teacher may have continued paying her mortgage, continued to remain on time, but that didn't help her rebuild her credit. On the other hand, when she eventually needs to retire and move out of that house and get something that's appropriate for retirement, a little bit smaller, she'd raise 3 or 4 kids there. At that time, they wouldn't be able to come after her for a balance. So.
Mm-hmm. Okay, well, we both learned something on
right.
it anyway. So, taking something like that back to the credit, if you're looking at someone's credit, Carolyn, and we always state that you want to talk to Carolyn as a mortgage planner, because there are things that you might want to suggest months out that they need to do now to get themselves and their money seasoned.
Correct.
We always like that word, seasoned money.
Right.
So just knowing what their situations are going to be, you might want to talk to them 6 months out just so that you have an idea of what they're talking about. And I know Eric mentioned one of our tips, which was that credit card with the 30% on. Let's talk a little bit about what you want to look at as a total picture and how you might help them.
Okay. Thank you, Jean. Yeah, it's absolutely. I can't recommend or suggest any. Know what I'm trying to say.
I know we're fighting a thunderstorm here. We're wondering maybe it's affecting us. Yes, you might want to stress enough
mm-hmm. as far as when people are starting to think about purchasing a home. To really, if you're 6 months out, it's a fantastic time to talk to us because we can give you some ideas, let you know, as far as what to expect as far as closing costs and down payments. But like you mentioned, the big one is the credit, especially, we all have these things with our bank statements or with, certain credit cards where they give you a credit score, but it's not always, actually, I would probably say 90% of the time, it's not going to be the same score that we have. It's a consumer credit score. And so when we pull your credit, there could be some things that pop up that not necessarily going to pop up on a consumer's credit card or credit report.
And before we go any farther, go ahead and give out your website or your email and your phone number, because we're going to be talking about some things that you might want to write down and give Carolyn a call, because you are what I love about working with you, Carolyn, is you're just a phone call away. So many of the on-site places, you've got to fill out paperwork. You never talk to anybody. You don't even know if they are really looking at you as an individual and what they can do. Where you can talk to someone within a half an hour's time and know exactly where you can place them and what you need to do to get them. Tell us the meaning of seasoned money, too, because we're always making fun of that. But go ahead.
So my name is Carolyn Wolf, and my website is www.floridalendingpro.com. And my phone number is 321-795-9103.
And you're right here in
Brevard County, in Indian Harbor Beach.
Walk right in and make an appointment, see Carolyn, or on the phone.
Right. And that is one reason why I worked for a bank for years, but I love being a broker because I get to work for my clients. Mm-hmm. I'm not, and a lot of people will as working for a bank. However, they have their products and they need a cross-sell or they need to push something here or there, but that's the one beauty of my position is that I'm independent and I work for my clients. So I put them in exactly where I think they should be.
Explain a little bit about what Eric had mentioned about the credit card and how if you're trying to establish your credit or maybe increase your credit line or even credit scores, about that little tip about the percentage that you want to keep on credit cards.
Right. Like Eric was saying, so as far as credit cards, when we have a limit that the lender gives us or the credit card gives us, say it's $1,000, if we exceed 30% of that balance, it can affect our credit score, which most consumers don't know. I didn't know that. They don't tell us that kind of thing. And you think, oh, great, they gave me $1,000. Why can't I use up to $1,000? Well, you can. It just lowers your credit score. And as far as what Eric was saying, too, as far as bankruptcies, sometimes depending on whether they reaffirm or they don't, or they're starting from scratch, another good tip is if you have some cash, you can go to your bank, some banks, and you can do what's called a secured credit card, where you give them a little bit of your money, say $500, and say, hey, and they're not going to take it, they're just going to hold it, and you're asking them to trust you, and you use that as collateral, so to speak, to start growing credit. So it's called a secured credit card.
Would that be like a prepaid credit card you could buy in a store, except that doesn't have any tracking for you as far as
No, this is different because you're giving them $500. They hold it in an account. So you can't access it, and then they give you a credit card, and they'll usually give you a $300 limit. So you're going to use it just like a credit card. So you have that $300 limit. You get the bill. You pay that bill. You don't ever rely on the money that's sitting at the bank because that is just security. In case you don't pay and you default, then the bank will come and grab out of that account. Mm-hmm. So it's very different than a prepaid.
So that that little 30% that we talked about, and we'll use $1,000 as an idea because most people have at least $1,000 line of credit. Some people have $10,000 line of credit, whatever. But that 30% threshold, you don't want to go over that. So if you have $1,000 credit line on a credit card, not necessarily the secured one I'm talking about, but just in general, you don't want to go over, what's the magic number?
30%, so it'd be $300.
$300. And you should pay that off if you can every month, so you don't ever go over that 30%. And what was the other tips that if you want to have a little bit more credit, either open up new accounts, or what would be the other tips?
Actually, ironically, I think paying off your entire balance every month is not going to help build your credit. Ironically, running a balance and then getting the interest off you is actually what's going to give you a better credit score. It's a twisted system.
It really is, yes, but it's true.
So let's give a couple scenarios where we all could maybe understand and benefit from the different services that are out there. So one of the things that I was looking up about bankruptcies, one of the biggest challenges is there's about 5 typical things that people go bankrupt, and the first one is usually medical. Is that what you found, Eric?
Yeah, well, I don't know exactly what the percentages are, but I have a lot of filers who have been sick, or they've had a family member who's been sick, or a disabled kid maybe, or an elderly parent that they're supporting. Then divorce is a big one. Of course, job loss is huge. Just imagine not getting a paycheck for a couple of weeks or a couple of months. Yeah. Imagine what that's going to do to your finances.
Right. Well, they always say to have 6 months socked away in case you do get laid off, but it doesn't take much to go through that 6 months, especially for people that might be over the age of 45 or 50. It's finding harder and harder to find out work. So there's always those unopportune situations that come up in life that you may have to look at bankruptcy. But let's just say, for an example, that for whatever reason, you just don't have enough coming in that's going out. Let's start with you, Carolyn. What are some of the things they might be able to do? Maybe refinance, as long as they can show that they can make the payment. Would that be something that they could qualify for? Maybe a refinance, or
they could, especially if you have, like you were saying, if it's somebody who's been in the home for a while, maybe they've had the mortgage for 10 years. And now they are having a hard time paying it, they could, in essence, refinance into another 30-year mortgage to stretch out the payment if they needed to, something like that. And or if they have enough equity in the home, we usually have them bring in all their debts, all the credit cards, all the car loans, analyze what the interest rates are, and if there's enough equity in the home, cash out to pay down those higher interest credit cards can maybe help them lower their payment as well.
And that's not something I ever encourage people to do, to take money out of their home, let the banks into their home to pay off debt, which, if they qualify for bankruptcy, would be 100% dischargeable. I mean, nobody's going to be looking after them when they're older and cannot work. And all my clients, practically every single one of them, they always would say, well, I always thought I'd work till I was dead. Well, they didn't work till they were dead because, of old age discrimination. They got fired when they got old, or they got fired when they got sick, and then they don't have the income, and now there's a huge mortgage on your house. So taking money out of your home to pay off what could be completely wiped away in a bankruptcy, it helps the banks. It doesn't help this community.
And some of the things that happened back in about maybe 2009, when was the banks, when were we bailing out the banks? Around 2008
is when it started.
And now, just as a little plug for the Hardest Hit program, which we talk about all the time, if you are finding yourself in a situation where you are making less, maybe you've gotten laid off and you're finding that mortgage payment a little difficult, you may want to consider the Hardest Hit program, and we won't go into a lot of it today, but you can call Jonathan Lack at Lack & Lack Chartered at 321-953-5115. There's money available that a lot of the banks, I think Bank of America is one of the biggest ones, that had to put money into this till, if you will. It's something that they can draw on now for the people that were having trouble making their payments. So there's money available to help you if you need to make those payments. Either if you're in the rears, it'll pay it up to date, or if you're out of work, it'll pay you up to about a year in advance of your mortgage payment. So there's all kinds of services out there that are available. All you need to know is maybe talking to some of the consultants that we have on our show. You can always give me a call. We can get you with the right person, because it's not always one or two ways. We always think, if I'm behind on my payments, I have to sell my house. Not necessarily. Maybe you could qualify for Hardest Hit. If I'm way behind, I have no way. I'm going to go to debtor's jail. I don't think they have that anymore, do they, Eric? But no, if the final situation is bankruptcy, then you want to know exactly how to lay out that plan. Just like we do with getting a mortgage, you need to lay out the plan on how you're going to do the bankruptcy, so you don't necessarily do something permanent that you might be able to rectify and right now or later. Any other tips that you could give us on what you find that people are looking for as far as getting that credit score up, or doing some various things that might help tend to what am I trying to say here? Discourage having to do anything drastic like going to bankruptcy. That's usually the final result. What are some of the things that you might be able to see, Eric, coming into your office that you help advise people on, or you might want to say this is what you want to make sure you do, because you certainly don't want to necessarily go out there and do some things like the season money that we talk about, Carolyn. You don't want to necessarily do some things that'll jeopardize you. And I think one of the things is you don't want to charge a bunch of things on credit cards and then try to dismiss it. That's one of the things.
Right. Well, if a there's thousands of people in this county who filed bankruptcy during the recession, and now they're ready to buy a house. And but for those people, probably a lot of millennials, sadly, who are facing bankruptcy now, you don't want to have a paid-in-full car, because it's here in Florida we don't get much of an exemption to cover a fully paid car in bankruptcy, which means it's going to get seized and potentially sold to pay your creditors. So it's better to more or less owe what your car is worth. If it's worth $5, you owe $5, then it's not an asset. You are not supposed to have used credit cards within 90 days of filing. Any type of asset can be problematic in a bankruptcy, but retirement is 100% protected, which is sadly why, especially during the recession, I saw so many boomers who had tens of thousands, in some cases hundreds of thousands in retirement, and they went through every last penny of it before they ever spoke to an attorney.
And they still got taxed on it too. That was the biggest peeve of mine.
They had such faith in, the American system. They thought, well, I'm running through it now. I'll get back on my feet. And a lot of them never even got back to work. They lost their job, maybe at the Cape or whatever. And, after that, maybe they were working at Home Depot for $10. And every single cent of that would have been protected in a bankruptcy. So don't run through your retirement paying creditors that can just be discharged. Keep in mind, those banks, they get money at almost 0% interest printed from the U.S. Treasury. It's printed, it's loaned to the bank at almost 0% interest. So running through your retirement to pay that back is not a smart way to go.
All right. You mentioned about the car because that kind of intrigued me. So what about a house? So say you have a house and you have 50% equity in it. Do they seize that, or is a house protected?
Here in Florida, Florida's big thing is you can protect up to $125,000 of dollars of equity in a home.
Okay.
Within the city limits, that's limited to a home on a half acre. Now, if you're out in the county, it can be more than a half acre, but you always want to look at your lot size. And then if you've been in the home for longer than 4 years, I believe more than 125 can be protected, but I very, very rarely have clients with that amount of equity.
Right, I know. It's America.
Yes, yes.
So that doesn't necessarily mean that's how much the house is worth. They could have a $300,000 house, but as long as they don't have more than 125 in equity and the rest on a mortgage or something
the
like
equity is what's left after the mortgage,
Right.
in the event of the mortgage being paid. So if you have a $300,000 house, but you owe $250 on it, then you only have $50,000 of equity.
Or you could reaffirm it
You could reaffirm
and just
it.
continue to make the mortgage payment, but just get everything else.
But we'd still
clear.
want to throw the homestead exemption on that $50K of equity.
Right. Okay.
Otherwise, it could get seized in the bankruptcy.
Okay. Gotcha. Okay.
And
That's
then
what I.
here in Florida, if you do claim homestead, you're then limited to only $1,000 towards a car and $1,000 what they call wild card towards money in the bank, household stuff, and again, retirement's 100% protected.
Right.
Now, if you're not claiming homestead, you either don't own a home or maybe it's going into foreclosure, and so you're just not going to be protecting it. Then you get up to, then you get $1,000 towards a car and $5,000 towards wild card.
Wow. This is a lot of good information. Definitely worth talking to you.
Anytime.
Yeah.
That's right. So, Eric, on that note, give out your phone number and your email address again, and you can contact Eric and set up a consultation. I'll be happy to go over your finances with you and see exactly where you fall into the situation that might be bankruptcy or might be some other. While we're talking, we have another minute left. Quickly tell the difference between, after you give out your information, the difference between Chapter 7 and Chapter 11.
Oh, okay, sure. Yeah, so again, my name is Eric Morgan. My phone number is here in Brevard is 321-253-6223. That's 321-253-6223. My website is spacecoastbankruptcy.com, and I'm on Aurora Road in Melbourne. Now, the difference between a 7 and a... there's several chapters. 7's the most common, and that's a liquidation bankruptcy typically used by people who make less than median income for their household size. So for a household of 4, that'd be less than approximately $65,000. Household of 2, that's $50,000. Anyways, in a 7, you're going to just wipe out all your unsecured debts and either reaffirm on your home and your car or potentially let them go into the bankruptcy as well. Now, in a Chapter 13, typically used by people who are over median income, it's going to be a payback type bankruptcy where you'll either pay all or a percentage of your debts back across a 5-year period. Now, people who are over median can sometimes still fit into a Chapter 7. So for those of you who are not interested in spending 5 years in a bankruptcy, do consult with an attorney. Even if your income's a bit higher, you still may fit in.
Wow. Well, again, we have more information packed in there. Thank you so much, Carolyn Wolf, for joining us today with Certified Mortgage Planners.
Thank you, Jean.
And Eric Morgan, it's always a pleasure talking with you and finding out all about the various things that we can do to protect ourselves, whether criminal or bankruptcy or what other topics did you say that you specialize in?
I handle injury, criminal defense, traffic, bankruptcy, foreclosure defense. I've done a smidge of family and immigration over the years, and but I don't always have to talk about those things. I'm happy to, whatever the topics you guys have.
Well, we really appreciate you being here today, and thank you all for listening in to Your Hometown Solutions, where we cover everything from foreclosures to
Feng Shui.
Thank you. Thanks, everyone. We'll see you next week.